Hi, I really hope you enjoy this educational video. My name is Mark Byelich. I'm a certified financial planner, and my team and I focus on developing tax efficient or tax free retirement strategies for our clients. We also focus on investment strategies that allow folks to eliminate the worry and have the potential growth that you need in retirement. So enjoy the video, and at the end, I'll tell you how you can schedule a no cost, no obligation consultation with me. Enjoy. Morning, everybody. It is 10 o'clock and we're ready to start our Tuesday morning webinar. Good to see everybody. Give a couple minutes for everybody to come on in and join us. A lot to talk about today, just like always. We've got your market updates. We've got a financial planning section. And we'll talk a little bit about our webinar scheduled for next week. There's a schedule change. We're going to do a special webinar tomorrow evening, the 25th, but due to a scheduling conflict, we moved it to September 1st. You should have all been receiving those emails. Many of you have already registered. So I know you're getting the emails. But it's 10 o'clock. I hope everyone's doing well, and I'm going to go ahead and get started. Just do me a favor, raise your hand if you can hear me okay. Great, thank you very much. So I just want to remind everyone that you are muted. There's a Q&A section at the bottom of the screen. The chat is disabled and you of course are being recorded. And I hope you're taking advantage of the recordings on the website. When I sent out the invitation for the special webinar, someone wrote back to me and said, can't you please do these webinars in the afternoon? And sometimes I hear people say, well, I can't, I really want to attend the 10 o'clock webinars, but I'm working and I can't. Or they say the 6:30 ones on Wednesday, that's my whatever night. So now we're making it really easy for you, and you can access these webinars currently on the website. I say currently because there may be a period of time in the not so distant future when you may have to be a client to access those webinars, but right now they're available to everybody. I expect that to stay that way at least through the end of the year. Today for planning, after we talk about the markets a bit, I'm going to talk about how much should one contribute to his or her 401k. So I had a conversation with a client, and a lot of these topics I discussed for you come from conversations with clients, and they have to do with questions that are going on in their financial plan. So in this case, this client was asking, I've got a new 401k, and this is his second career. So I have a new 401k, and they have a Roth option in their 401k. How much should I be contributing to that 401k? So I'm going to talk a bit about how we work through that question and what the pros and cons of what you should be looking at for contributing to your 401k. And if you're done with 401ks, pay attention to this because it might be beneficial to your kids. You know, a lot of my clients come to me and say, I passed on your information to my kids to help them get on the road early and get started early. Or I'd like you to talk to my kids. I'm always happy to talk to my clients' children or loved ones. That's part of the deal when you become clients of ours, that your people close to you, you know, the people in your life that you love, will help you with them as well. So it means, you know, your children, they don't have to have that, you know, minimum $1 million to work with us. That's all part of the agreement, right? They can still get our advice and our help. So a lot of people find that helpful, and it's you all know it's good to start early. So let's just see if I have any questions. No questions. Let's move you guys up here. All right. So I'm going to start with the slot updates and the slot report as I've been. And this is from Andy. We're going to be talking to Andy tomorrow night. This was a really great letter that came in. I read it at about 10 o'clock last night, but it came in yesterday morning. And at first I was going to tell you folks, there was really nothing interesting in the slot updates this week, but then this letter from Andy came in. There were good things, but things that we have talked about before, and just nothing that really got me, but this one got me. So I'm going to read this letter that came in. I'm sorry, I'm going to read this synopsis that Andy gives us, and it's about a letter that came in from a financial advisor. You got to watch, make sure these people are doing the right thing for you. So recently, I had a conversation with an advisor, Andy writes, who wanted a second opinion. He disagreed with how a 401 custodian. So the 401k custodian is the company that holds the 401k plans. The biggest one in the country is Fidelity, but it could be Fidelity, Vanguard, Transamerica, whomever, but that's the custodian. So the 401k custodian was handling his clients' required minimum distribution. So this client had reached age 72 and had a required minimum distribution. Clearly, the client wasn't working anymore. To arm himself with facts, the advisor contacted us so he could push back on that custodian. After listening to the details, the scenario was clear. It brought me no joy to inform the advisor the custodian was correct, and there was no fix for what the advisor had done. I could offer no magic corrective bullet. Deflated, the advisor realized he had to explain how his faulty advice cost the client an additional and unnecessary $25,000 in taxable earned income for the year. So not $25,000 in tax, but $25,000 in earned income that he's going to have to pay tax on. So, Andy, he writes well, and he really sets this up nicely. So the advisor calls in and says, hey, I'm getting bad information, I believe, from this custodian. They're all wrong. Help me, give me some information I can come back with. Now, they are clearly not a slot, part of the slot group. And this goes back to, I have my previous advisor once, or my previous partner once said to me, Mark, I don't know why you're involved with this group, but we've both been in the business for the same amount of time. How in the world could you know more about IRAs and IRA distributions than me? And this is a perfect example about how your average advisor does not know the rules. And that person, I said, attend one of our training events and see. So at that training event, he became a member of our group, and he's still there today, as far as I know. So where did this advisor go wrong? The one Andy just described. Well, he botched the RMD aggregation rules. People think that you can just take all of your IRA and 401k money and collect your RMDs, your required minimum distribution. And let me back up just in case you don't know. So a required minimum distribution is a minimum distribution that, of course, is required. The IRS requires it, that you must take out of your retirement accounts after you have attained the age of 72. So after you turn 72, you have to take required minimum distribution. And there's a table that's on our website that you can look at to see how much that should be. And I'll show you where that table is in a moment. So he's talking about required minimum distributions. Now, if you don't take a required minimum distribution, the fine, the penalty is 50% of what you should have taken. So this is a serious deal. Now, this doesn't go into penalties. This goes into aggregation. So what is aggregation? Aggregation is people believe that you can take all these values of the retirement accounts. So let's say you have $2 million in between your 401ks and your, I got a bug or something here, 401ks and IRAs. And you say, okay, well, I've got a $2 million value. I have to take about $70,000 in a required minimum distribution. I'm going to take it all out of my IRA. Well, there's a problem there, and we're going to talk about it. So here's the example. This client, Carl, age 74 and retired, has 3 different retirement accounts. An IRA at Bank One, just an example, with a $10,000 RMD, right? So that's not the balance, that's the required minimum distribution out of IRA One. IRA at Bank Two with a $17,000 required minimum distribution. So again, not the balance, but the required minimum distribution. And a 401k at his former employer with a $25,000 required minimum distribution. Carl is incorrectly informed by his advisor that he can add the IRA and plan RMDs together. So what Andy is saying is that he was told by his advisor that he could add the IRA and the retirement plan, the 401k balances together, the RMDs together, and take them all from any one of the accounts. In January, Carl took a $52,000 withdrawal from his IRA at Bank One. Carl was under the false impression that his annual RMDs were satisfied because that's what his advisor told him. 6 months later, Carl and the advisor contacted the 401k and requested a full rollover of the plan assets to one of Carl's IRAs. The 401k custodian informed Carl that they would send one check to the rollover to be rolled over and another check for the $25,000 plan RMD. Carl said, but I already took my plan RMD. I took it from my IRA. Their conversation deteriorated from there. The custodian was correct in this situation, and Carl proceeded with the full rollover. He would have compounded his problems by creating an excess contribution in his IRA for the RMD amount. RMDs can't be rolled over. As things stood, Carl needed to take an additional $25,000 from his plan. Unfortunately, he could not roll over the previous $25,000 he took from the IRA because it was after 60 days. If he hadn't done any previous 60-day rollovers, he could have treated that as a 60-day distribution, put it back, but they're beyond the, remember, 6 months, beyond 60 days. That withdrawal had to remain as a normal and unnecessary distribution. So this individual, Carl, had to take that additional $25,000. He already thought it was taken from his, covered his RMD from his IRA, but he learned that he can't do this. The advisor should have known that and incorrectly advised him. So be careful with multiple required minimum distribution. The basic aggregation rules are as follows. Write this down if this might be you. IRAs, including SEP and simple IRAs, RMDs for each IRA account must be calculated separately, but the total RMD for all IRA accounts may be taken from one or more IRAs. So with IRA accounts, if you have the same situation, $2 million all in IRAs, and you've got 4 different IRA accounts, you can take your RMD just from one IRA. We do that all the time. The problem is when you lay over retirement plans, 401ks, 403bs, they have to be taken separately, but IRAs can be aggregated. Company plans, excluding 403bs and IRA-based plans, RMDs for each company plan, excluding 403bs and IRA-based plans like a SEP or a simple, must be calculated separately for each plan and taken separately for each plan. You can see where this can become a problem when you're over 72 years old. And if you haven't consolidated things like many people want to do when they come to us, because if you've got 2 or 3 401ks, then now you have to take RMDs from 2 or 3 plans. 403b plans are a little different. RMDs for each 403b account must be calculated separately, but the total RMD for all 403b accounts may be taken from one or more of the 403b accounts. It gets very confusing, folks. So if you think that was very confusing, you're right. The moral of the story is make sure you're working with someone who's knowledgeable and understands this. This is information we're getting all the time. You're going to hear from Andy next week, and you're going to get a little flavor of just the depth and breadth of knowledge that we have with the Slack group. But I don't expect you to know all these rules when you hear these updates or hear the slot bag or slot reports. They call them this one's the slot report. Sometimes they call them the slot mailbag, and that's what it is. But just to bring some awareness, I want you to just be aware if someone says to you, hey, we can just pull all that money out of an IRA and you can leave the money in the 401k. And if you're for required minimum distributions, you just might trigger that. Like, you know what? I think I heard something about that. So let me check on it. Okay, there was an interesting piece I read last week on MarketWatch, and it had to do with the Social Security COLA, so cost of living adjustment. So we've talked a lot about the Bureau of Labor Statistics. The numbers came out a few weeks ago, and it gave us our year-over-year inflation for June. I think it was June. Maybe it feels too early to be July, but I think it was June, of about 5.4%. So people were speculating that the increase for Social Security is going to be very high this year. There's a discussion in this piece, and it's by a fellow named Brett Ahrens. And the piece is called, if you want to read it, Social Security Calculations Cost Recipients Hundreds of Dollars a Year. And I bring it to your attention because it talks a little bit about just the difference between what the Bureau of Labor Statistics calculates for inflation and what Social Security uses for inflation. For example, he uses an example. The government thinks housing inflation is running at a mere 2.8% a year. We see housing at a much higher level. A good average for housing is about 4.1%. In some areas, it's much higher than that. In most areas, at least around here, it's higher. But it just, the National Housing Price Index is rising at 16% a year. He's saying the S&P Case-Shiller National House Index. But the reason I bring this to you is don't count on a massive increase for Social Security, even though we're seeing these big rises in and inflation, because there is a different type of adjustment. And this is a good article to read if you're interested in that. Talks about new tenants with new rents compared to someone staying in their house. Because if you're staying in your house, obviously the cost of housing isn't going to affect you as much when you're retired and staying in your house. So they do take those things into consideration. So again, that is a piece on Market Watch, and it is called Social Security Calculations Could Cost Recipients Hundreds of Dollars a Year. And this is a good just awareness piece. If you want me to send you the link, just send me an email and I'll send you the link. No recommendations there, just as I said, I thought it was an interesting piece. All right, so now let's talk about market returns. So this is for the week ended August 2021. I can't believe it's the end of August already. I was walking with my wife last night and I said, people are already saying when I talked to them on the phone, well, how was your summer? Summer's over, right? Kids go back to school next week. My daughter actually started, I think, yesterday. And I just can't believe the summer is basically over at this point. But so here's where we are for that week. The Dow Jones Industrial Average was down 1%, still up 16% for the year, and year over year. So August 20th last year to August 20th this year, up 29.18%. The S&P was down about 0.55% last week. The NASDAQ was down last week. The MSCI World, excluding the US, was down 3%. Emerging markets index was down almost 5%. So overall, across the board, all the indices were down. So obviously a lot of concerns last week. Global economic issues. We've got everything going on in Afghanistan. We've got this new talk of, COVID, all these different variants. Nobody knows what that's going to look like. We started trying to plan our university classes again, and we just decided to do online classes. So, things are still very uncertain, and the market doesn't like uncertainty. But so far, it's been a great year. As I've said, if we close the year with the Dow Jones Industrial Average at 16%, folks, that's a great year. We should be really, really thankful of the rebound we had from last June to now, and the returns we've had so far this year. We should be really, really happy with that. So don't fret about it too much. Just be prepared, build your foundation, like you hear me say. Make sure you've got your investments in the right buckets from a tax efficiency point of view. We're going to talk about that a little bit today. Make sure you've got your asset allocation, your principal protection, your account segmentation, and if it works for you, your lifetime income. Well, everybody should have lifetime income, even if it's a pension, Social Security, or you set up your own lifetime income. Everybody should have that as part of your foundation, in my opinion. So how about the Treasury notes? There's an interesting bit from Riverfront that we're going to talk about in a bit, where they're talking about the effect of, well, I'll wait for that. But the U.S. Treasury, 10-year Treasury was down again last week, went from 1.28 to 1.26. Interest rates are so unbelievably low, and there is some talk that's hopefully will change at some point, but not too optimistic that it's going to happen quickly. So I talked about the consumer price index. We saw the July report, 5.4. May was 5. April was 4.2. Inflation is very, very high. Personal consumption is up, of course, year over year, over last year, 13.6%. So the big question with inflation is if this is an anomaly from a pandemic year to a coming out of pandemic year, and people are out and about and spending, or if this is a trend that we're going to see with higher inflation for some time. We've had low inflation for a long period of time, so it is reasonable that we're going to have higher inflation for a period of time. That's how it works, right? So I talked about Riverfront, and they were talking about the Jackson Hole Symposium this week, and they think that this is going to be they refer to it as a 2-minute warning. So they think that they're going to have some discussion about the Fed slowing the size of its bond purchasing program known as quantitative easing. So quantitative easing is a really fancy way of the Fed saying we're going to issue bonds and then we're going to buy those bonds back, and that creates money in the supply out there. They write the U.S. has a supply issue and not a demand issue, and just needs time for that to balance out. So when I read that summary, I was really interested because I immediately thought about goods, supply issue of goods, not a demand issue. And we know that's reversed right now. Everything's in back order and more expensive. It's difficult to buy a new car. It's difficult to get just about anything. And we're all paying up for it a bit. But they're talking about money supply. So as I read into the article more, they were talking about the money supply. There's a lot of cash out there. Banks have a lot of cash. Individuals have a lot of cash that they're holding on to. And that's the supply issue as opposed to the demand issue. So that was interesting. So they write that they expect a 10-year treasury. We just talked about it. It was what, 1.26. We expect a 10-year treasury to finish the year in the 1.5 to 1.75% range, and the stock markets to continue to grind higher. So optimistic, but you expect that from a money manager who Riverfront is. I expect their optimism. So again, what's the answer to all this uncertainty around the world and how we proceed with investments? Well, it's not easy, but it's simple, right? Remember, build that foundation. Just like, I know you've heard me say it a million times, but in San Francisco, they build the buildings. They know that they're going to have some earthquakes and there's going to have some damage, but they build them so they're not going to crumble. That's what you want. Asset allocation, make sure you're using the best investments available that fit into that. I'm going like this because I'm talking about that pie chart. So you need asset allocation, some level of principal protection, some portion of your portfolio that isn't going to go below zero if the markets crash or when the markets crash again. Account segmentation, this is when you divide up your funds and asset allocate those funds for each segment of your life. So we know that the funding is going to be there when you need it. This allows you to eliminate that worry of where's my money coming from and get rid of that fear of missing out, about, not having growth in your investments. Because if you just invest it in one pie chart, it's supposed to cover the entirety of your life. It may work, it may not work, but I want more certainty in our plans. And of course, guaranteed income is a really important part of that. You want to make sure that you've got something that's going to live as long as you do, as far as an income stream. Okay, so now let's talk about planning. I've got an old note in here I got to get rid of. So we are talking today about how much money should I put in my 401k? No questions. Good. So I told you in the top of this, or at the top of this, that this came from a question a client had. So a client had a new job, and he said to me, how much should I contribute to this 401k? Well, my first question, you can guess, was, is there a Roth option in the 401k? Client's over 50 years old. Yes, he comes back, there is a Roth option. So let me walk through with you on the whiteboard the process for this, because at the end of the conversation, it's a very sharp individual. He's been investing for a long time. He's actually doing his PhD, or finished his PhD. So he's a new PhD, he's a smart guy. And at the end of the conversation, he said, you know what, I hadn't considered that. So I always like that when I hear that, right? Because that's what people bring us into the fold for. So let me walk through with you via whiteboard what the discussion process is, and this might help you. So I'm going to share my screen here and pull up my whiteboard. All right, you should see a whiteboard in front of you now, and if you do, raise your hand for me. Great, thank you. Let me first tell you where I got this chart. So if we go to, all right, you should see my website in front of you. Hopefully you see that. Raise your hand if you see my website in front of you. There are a ton of new resources of articles, calculators. These calculators are great. There are these aren't videos of me, but there are other videos, presentations, ebooks. So there's a lot of stuff. So, but in the slot corner that we build out, there's a couple of videos. This is me and Ed. Ed's talking about his philosophies, and this is a great watch. It's an hour. So you can go on there and look at that. But here are these tables, and this is where I'm getting the table I'm going to share with you. So the first thing I talked about with you earlier was required minimum distributions. If you remember, we were talking about the folks with the aggregations, and you got to figure out how much you're taking out. Well, this is the uniform lifetime table as it stands today. This is subject to change. This is going to change. I believe it's next year. It was delayed. But if you're 72 years old, you calculate the value of all of your accounts, right? And then you divide it by this number here. And that's the amount that you have to take. And you either have to take it as an aggregate, or you can't take it as an aggregate, or you have to take it separately, or you can take it separately if it's IRAs. You have to take it separately if it's retirement plans, as we talked about. So you can download that. You hit this download button. You got to put in your email and you can download it. And today we're going to go over this chart. This is the retirement plan contribution limits. So if you want this, you can download it. But here's my whiteboard. Back to my whiteboard. So you're going to see me looking down because I'm drawing here. So the question was, just to remind you, how much should I contribute to my 401k? Well, I told you my first question. Is there a Roth 401k? Yes, there is a Roth 401k. So that's good news, because what do we say about traditional 401ks? And what's the difference? The difference is with a traditional 401k, no tax now, tax later. That's the deal. It's deferred. You don't pay tax now. 401ks are done by payroll deduction. So if you contribute the maximum amount, if you're over 50, the number is right here. I can make that a little larger, and my brain's going to get larger here. That's okay. We're going to just focus on this box on this chart, and I'll go back and explain the rest of the chart for you in a moment, but we're just going to focus right here. These are 401ks and 403b plan limits. So with a traditional 401k, no tax now, but tax later. So they do a payroll deduction. You don't pay tax on it. If you contribute $26,000, you don't pay tax on that $26,000 when you contribute. But as it grows, and as it grows, it stays deferred. But when you take the money out via distribution or conversion or something like that, that's when you pay the tax later. The problem, of course, is what's the tax rate going to be later? What's that tax rate going to be? That's the I don't know tax rate. And I don't like to work in I don't knows. And we know for a fact that it's going to likely be higher sooner than we would like it to be. So we believe that the average middle class American is going to be in the 40 to 45% effective tax rate, which is much, much higher than what it is today. So traditional 401k, you know, no tax now, tax later. Really simple. A Roth 401k, tax now, no tax later. No tax for you, no tax for your heirs. The benefit, of course, of the 401k, Roth 401k, is that you know what the tax rate is now. We know what our marginal tax rates are. It goes from 10 to 37%, and we got gradients in between. But you know where you are, and you know what percentage you're going to pay. Effective 18%, effective 20%. You can plan that, you know. So it gets rid of the surprise. And if you're able to pay at 20 or so percent, and we know that it's going to be much, much higher in the future, I think that's a good deal. So tax now, no tax later. No tax for you, no tax for your heirs. So the Roth 401k, I think, makes the most sense. For traditional IRAs, we typically say, let me carry this down. Let me go back to traditional IRA. If there's a traditional, 401k, traditional 401k, if there's a match, contribute to the match, and then stop, right? No more after the match. So if you get a 3% match, that you contribute up to that level, and then you don't contribute anymore. Bringing you guys back over where I can see it. Sorry. Multiple monitors. So if you see me looking around, that's what's going on. So everybody can see my whiteboard again, right? Just let me check in. Raise your hand if you can see my whiteboard now. I hope I'm sitting here. I'm writing this. I hope people can see my whiteboard. Okay. Thank you. There was a delay and I was a little worried about that. I did a whole discussion with a prospective client one time, and they said, we can't see what you're writing. And it was about 20 minutes I was talking and writing. So I don't like that. So traditional 401k, if there's a match, contribute to the match and then stop. If no match that says match, jeez, it's not easy to write on this. Match, then no contribution. Don't waste your time. Unless you can do some kind of conversion right away, just for the most part, don't waste your time. But Roth 401k is a great resource. So we know, let me go back to this chart. Let me go back to this chart. With a Roth IRA, I'm over here. I want to remind you that there are phase out levels. So if you make more than $198,000 to $208,000 a year as a married person, or $125,000 to $140,000 as a single person, you start phasing out. It starts phasing out at 198, and you're completely left. You cannot contribute to a Roth IRA at anything over 208,000. That's your modified adjusted gross income. So the phase out simply means is that after you cross 198,000, it's less and less and less that you can contribute to that Roth IRA until it reaches zero. That is the same for a single filer. It's just much less. Now that's a Roth IRA. A Roth 401k, no income limits. So you can put the maximum amount in. The maximum amount if you're over 50 is $26,000. The maximum amount if you're under 50 is $19,500. I just had to double check that. So greater than 50 years. 19,500, less than 50 years. So that's a good amount of money that you can put away. And if you and your spouse are both employed and you both have a 401k plan, and it's both has a Roth option, then you can put away, $51,000 a year, and that's $52,000 a year, and that's a good amount of money. So there are the differences between Roth 401k and a traditional 401k. So now, how much should I contribute? So let's say you have a Roth 401k. There's no income limits. If you make even $1 million a year, you can contribute that maximum amount. But in this person's case, this is their second job. This is their job in retirement, remember. So he's making $75,000 a year. Now, let's talk about buckets, right? So $75,000 a year in income. Remember our buckets. We've got taxable, tax deferred. Remember, pay no tax now, pay tax later, tax free. Pay tax now, no tax later. The goal is to identify how much money you want in each one of these buckets and then push everything else over to here. So we know we want to keep 6 months to 1 year worth of expenses in this taxable bucket, right? This is money that funds you get 1099s on every year. These are your individual stocks that are not held in IRAs, and you get capital gains, you get interest, you get dividends, you get all these things that push out 1099s. 1099s equal tax. Tax deferred, it's your IRAs, traditional 401ks, traditional 403b plans. That's a 4. Anything that you've promised you're going to pay the tax later on. There is a mathematically ideal amount, you've heard me say, that you can keep in your IRA, or you may be able to keep in your IRA. For some people, it's zero. For some people, it's up to $500,000. So you got to determine what that amount is. Well, everything else should then shift. Everything above and beyond these numbers should then shift into the tax-free bucket. So I tell you that because that has to drive the decision, or help drive the decision about how much do I contribute, right? That was the question. How much should I contribute to 401k? So the clients came back to me and said, well, I thought about it. I get I think it was a 3% match. I'm just going to contribute a 3% match. I said, well, that's okay. But let's walk through it a little bit. So I happen to know that he has about $500,000 in this bucket. He's got about $2 million in this bucket. And we've been working together for a few years. So we are actively converting money from IRA to Roth IRA. Because remember, there's only 2 things that are truly tax-free that sit on this side of the ledger. And that's anything Roth and properly structured cash value of life insurance. And he's got both of those. So good. He's funding the Roth. He's funding the life insurance. The Roth money comes from here. The life insurance money comes from here. He's doing all the good things. I said to him, well, that's fine. This $75,000 worth of income, do you really need each penny of that? Tell me about your cash flow. Now, we've gone through financial planning with them every year. I had a good idea before he commented on it, but you never know. Things can change, right? And things always change. So I just wanted to see if anything changed for him. And he said, no, it's okay. And we still have this money here that we're living on, and he's getting some deferred income payments still for a couple of years. So I know he's got at least $100,000 a year that he has to pay tax on. It's still coming into that bucket. So I said, what if instead of just the match, now remember the match contribution, whether you have a Roth IRA or not, I keep saying IRA, whether you have a Roth 401k or not, the match has to go into the traditional side of the 401k. They're the rules. Your employer cannot match into your Roth, but you can. You can put $26,000 into your portion of the 401k into the Roth if you'd like to do that. So I said, well, what if instead of just the 3%, because he was talking about doing 3% to get the match, what if just the 3%, we put the whole 26,000 into the Roth 401k to help fill up this bucket faster? We're working really hard. We're paying tax. We're doing all these. We have got this strategy. $26,000 goes a long way towards that. He's probably going to be working for the next 10 years. So that's a good amount of money to be able to put aside. And then, of course, he's going to have to deduct about $30,000 or more from his income, right? If you include the tax, yeah, it's probably a little bit more than that, but let's just use 30,000. So that leaves him 40. Let me move it over here. So $75,000 worth of income minus $30,000 worth of adjustment for Roth 401k contributions. That leaves them $45,000 worth of spendable funds. You got to adjust some other tax for this income. Let's call it 38,000, just to make things simple. So the question is, okay, now if we put $26,000 into the Roth 401k, and he might say, well, I can't live off $38,000. Well, what about these other funds over here? What about the $500,000 that he has sitting here? Part of the plan is also bring that down, right, to 6 months or 1 year. And in his case, it works. It may not work for everybody, but in his case, it works because he still has I think it's $180,000 a year he gets in deferred comp for the next several years. So he can use that deferred compensation money that would normally just be filling up this bucket here and redirect it to his spending. So even if everything added up for him and he was able to do another $30,000, take it, I know this is getting a little complicated, take it out of this bucket and fund it. Let me do that a little more directly. So take it out of this bucket and fund it here. That's going to help us draw down here, still fund what he needs to do, right? He's a happy guy because he can pay his bills and do all the things that he wants to do, travel and everything that has to do with these retirement. But then we're still funding. I can't put red on the Roth side. It just doesn't work for me. We're still funding up this Roth bucket here. So that's where he said, oh, I didn't think about that. It's just taking, I think I use this analogy. It's funding from one pocket compared to the other, right? We want to build this up as much as we can. Well, we don't want to give up an opportunity to have this 26,000 back over here, having this 26,000 that we can push into the Roth IRA, or excuse me, Roth 401k, and then eventually roll it into a Roth IRA. But while we have this gift of the Roth 401k, why not take advantage of it as long as we can make his lifestyle work for him? Because none of this works. None of it works if you're not doing what you want to do in retirement, not meeting your needs, not meeting your goals, and not having the fun you want to have, travel, see the grandkids, all those things. So we have to balance that and make it all work. Let's get those red X's off of there. Does that make sense? Are there any questions? So, okay, good. Again, I either explained it really well or I've lost all of you. So the question for him is, right, it was how much should I contribute to my 401k? And for him, it's different for everybody. The answer is $26,000, right? We're going to fund the tax-free, tax advantage bucket. We're going to continue to fund that through conversions, through now contributions. That's a gift. He's going to live off of this side here. If we need to make adjustments, we can, right? If suddenly next year he needs more money and he says, well, I can't, I'd rather take that money and spend it for X, Y, and Z rather than defer it, we can make that change. That's easy. And because we have money here, we can do that. I'm back over here with this tax-free bucket, or excuse me, taxable bucket. But it's different for everybody, because if this was a much smaller amount, if we were spending money out of the IRA and contributing to the 401k or the Roth, I still might make the same recommendation, but I'd have to really look at the details. Listen, this is just sketched out on a whiteboard for you, but we throw it in their financial plan. We did it as a what if in their financial plan because I know conceptually it worked in my head. And when I got the message that he asked the question, I thought it through for a moment and I said, okay, this makes sense because I know this person. But we built out an alternate plan in their financial plan. Well, what if? It was actually a what if. What if they contribute $26,000 or 3%? And I compared them side by side. And I looked at the net effect to their portfolio in different circumstances because I want to be able to test and back up my theory. And I was able to do that. So the answer for this individual was solidly $26,000. So does that help? Is that helpful? Raise your hand if that was helpful. I can't wait to see you all in a live class again. So I am going to, at some point, when we get through all this craziness in the world, first of all, we have renovations finally begun. If you drive by the office at 1051 Lindenhurst Road, you're going to see a stone crew out there that is doing beautiful work on my ancient building there. So the original portion was built in 1685. I know they shared this with you. It was a log cabin. I have a historian helping me with gathering some information. The middle portion was somewhere in the late 1700s or early 1800s, and it's all stone on the outside. It's been terribly neglected, and they're going in and they're pulling out all the mortar that is hundreds of years old in some cases and replacing it with really great material that this company up in Telford develops and sells all around the world. They're real artisans and they're doing beautiful work. And that's just the start of it. So we have a lot of, we're expanding our office to the second floor as well. So I hope to have you all join us for a open house at some point, hopefully at the end of the year. But on top of that, we want to have a class soon, a live class soon. I hope you all can join me for that. But we're going to be scheduling a online class, the Changing World of Retirement series class, as soon as I can. I've got some travel in October and some travel in September that's affecting the timing of it, but I really want to get it in the next couple months. And then I've got an advanced class series that many of you have gone through before, but I'd love to do it again. It's good for me to refresh things, and I know it's good for you to hear it again. So I hope to see you all live soon. So that takes us to 10:44. I do have one question here. Gerard, hey Gerard, extending the RMD age beyond 72 is just going to take people into potentially higher tax rates. What are your thoughts? Well, don't forget. So Gerard's talking about there's really active conversation in Washington about extending the required minimum distribution age to 75. So just a year ago, well, 2 years ago now, I guess it was age 70 and a half. It moved to 72, and now it's projected to be age 75. For our purposes, I don't want to be glib about it and say it doesn't matter, but that's a required minimum distribution. It doesn't, if you're doing smart tax efficient planning, it shouldn't affect you. So it may affect you in the short term, but not in the long run. So the key is to start early and to have these conversions that you're doing, Roth conversions, done before your required minimum distribution date. But don't forget, RMDs can be tax-free. If you have the proper amount in your IRA, in your traditional bucket, right? Your tax deferred bucket, and you keep your required minimum distributions below your standard deduction, assuming you have no additional income, not counting Social Security, no rental income, no pension income, no things like that, then your R&Ds can be tax-free. And I can talk more about, I've gone over that several times, but they can be tax-free. So they're not horrible. They just have to be managed. And if they move it to age 75, it'll give our clients some more room to get things done. Gerard also talks. Gerard, just give you a background. So Gerard, I think either came to one of our classes or maybe joined us from the slot event we had a year or so ago. And Gerard is a retired advisor like myself, so he's always got great input. And we've had some great conversations. So Gerard writes, the sunset rates will expire. Sunset rates will expire. And what Gerard is talking about is the rates that, again, I'm going to show you on our website. So let me pull up our website. You can go to our tax planning chart, and that's the orange chart. And what Gerard is talking about here is these sections. Everybody sees the charts? Raise your hand if you see my chart. Okay, thank you. So Gerard is talking about these rates here. Now, I always draw them ascending or descending. This chart has them ascending, so from lowest to highest. These are the Tax Cuts and Jobs Act, commonly called the Trump tax rates. These are set to sunset December 31st, 2025. So they will expire. There is an interesting theory out there. David McKnight thinks that these taxes with some small adjustments might extend for another 8 years. And he thinks that it could be a 100% political maneuver by the Biden administration to help his folks stay in the White House and in Congress. And it might be. If that happens, that's really great for us because it gives us a lot more runway to get things done. But David is probably alone in that thought. I haven't heard anybody else who had posited that. I know Ed Slott disagrees with it. So that would be good. Maybe it's somewhere in the middle. But listen, these could sunset and expire. These rates could expire next year, or they could sunset in 2025. But good point, Gerard. Thanks for joining us again. All right, folks, it is nearly 11 o'clock. It's 10:48. I hope you have a great day. I hope you have a good week. We'll see you next Tuesday on the weekly webinar. We'll see you next Wednesday with my buddy Andy Ives from the Ed Slack group. Talk to you soon. Take care. If you need to schedule time with me, my calendar will populate, and we'll see you soon. Thanks. Take care. Hello again. I hope you enjoyed the video and perhaps you learned something new that can help you. If you want to schedule time for me for a no cost, no obligation consultation, you can use the link in the description and schedule a time that works best for you. If my schedule is full and you can't find anything, don't worry. Send us an email and we'll find a time that works for you. I look forward to speaking with you soon. Thank you. Have a great day.